Hey guys, I've been getting a lot of requests from YouTube, Twitter, Discord to explain how exactly does Maya, my new trading algorithm, go about finding its trade setups. Is it just flipping a coin? What exactly is it doing? Is it the method that I have described in my book, Mean Reversion Trading? So I thought I'd make a video explaining to you at a very high level what all does it consider before taking a trade. Now, trade exits are way more easier than trade entries. And because of that, I was able to make a flow chart for the trade exits. I'll link that in the description below. But let me go over what all does Maya take into account before entering a trade. The first thing I want to point out is if you have read this book, my best-selling book on options trading, I've mentioned in that book that if you are getting started with trading, or even if you are an advanced trader, try to limit the number of indicators on your screen. Too many indicators causes analysis paralysis and creates signals all over the place. I've gone through that in my own trading journey, and frankly speaking, it doesn't help at all. In fact, it hurts more than it helps. Now, when you are talking about computers, everything changes. So, with computers, the nice thing is that uh, whether you take 5 indicators or you take 500 indicators, the computer never gets confused. It just a way of repeating instructions over and over again. So the instructions could be 10 lines of code, could be 500 lines of code. It really doesn't care. So that's the nice thing about a computer. So there is no real reason for you to restrict the number of indicators in a trading algorithm. I also want to mention that a trading algorithm is just a set of computer code. It's a set of instructions which the computer is executing. So the algorithm doesn't even know what a stock market is, what an indicator is, even what a stock is. It doesn't really know that. So as a developer, as a programmer, you have to give it meaningful context because all in the end, all the algorithm will do is compare certain numbers. If this is greater than that, then do this. That's what really code is. So to give it context and to make the algorithm understand what exactly the stock market, you need far more indicators than what a human needs. When I'm trading, I know exactly what the stock market is. I know when I'm looking at a chart, what the chart is telling me. And then I use indicators to just add confirmation. For a computer, everything, the visual image that it's creating in its mind of the stock market, the quote unquote understanding of the stock market it has is coming from indicators. Just wanted to throw that out there that you do need more than a handful of indicators when uh, developing a trading algorithm. Now, how does Maya pick its trades? So, at the highest level, what Maya does is there are two separate exercises that it goes through. Number one, it forms an overall view of the market. So, a broader view of where the market is going. So, is it a bullish market? Is it a bearish market? Is it a pullback or correction happening in a bull market? So, it has it has to have this uh, macro level, 30,000 foot view of the market. So for that, it uses a benchmark. So Maya uses QQQ as its benchmark. You could use SPY too, but Maya uses QQQ. And the reason I chose that is because I mostly trade tech stocks, and QQQ is more volatile and can be used as a leading indicator when viewing the market. So I always say this that SPY is the well-behaved cousin of QQQ. Any kind of exaggerated move a pullback or correction first shows up in QQQ, and then S&P 500 or SPY will follow. So I use Qs as my benchmark. So it uses that and applies some indicators to that to figure out if it's a bull market or bear market. So for example, it uses multiple time frame analysis on the charts and superimposes a weekly chart on top of a monthly chart and sees where different time frames are telling it the same story. That's one way of doing it. The other ways are it uses VIX or the fear gauge of the market. So it uses different levels of VIX to figure out uh, what exactly the market is doing. For example, um, the algo is extremely accurate in detecting a pullback or correction. In fact, the most recent correction we had on February 18th, it started on February 18th, 2025. The algo nailed down the correction on 21st February. So it's very good at that. And it used a combination of VIX EMAs and MACD indicators superimposed on QQQ to detect that. In its current state, the algorithm only takes bullish trades. And yes, an argument can be made that you can make money in bull or bear markets, but at least the back tests that I did for the last 10 years showed that every time I introduced bear put spreads into the mix, the win rate drops from 75% to like in the low 40s. The algorithm in its current state only takes bullish trades. When the markets go into a pullback or correction, it stops taking trades, it reduces its exposure to the market, and then it focuses purely on trade management. Trade management meaning it may have a bunch of trades open before the pullback starts happening. It will just focus daily on closing the losers before they become too big. So that's how the algorithm works. And finally, it also uses sector rotation. So you must already know this that there are certain sectors called defensive sectors, and there are certain sectors called the risk on sectors or growth sectors. So when VIX is low, when markets are trending up, there is no fear in the market. All the growth sectors, for example, technology is an example of that. Technology, financials, could be consumer discretionary. All these sectors start going up. Money starts flowing into the riskier parts of the market. And when things are not going well, there's fear in the market, uncertainty in the market, money starts getting diverted to consumer defensives. For example, consumer staples. Like everybody needs to go to Walmart no matter what, right? Even if you're in a recession, you will still go to Walmart. Walmart is part of consumer staples. Then you have healthcare, which is the XLV sector. So there are certain sectors called which fall under the defensive sector umbrella, and money starts going there when fear is high in the market. So the algo calculates sector strength on a daily basis. And if it detects that money is starting to flow into the defensive sectors, it starts getting conservative. And what it does is it drops its exposure to the market. So for example, it could be trading at, let's say, 50% exposure to the markets when markets are going up and VIX is low and there is no uncertainty or fear. The moment it detects money flowing into consumer defensive, it may drop its allocation down to 10% or even 5%. So by doing that, it kind of protects itself even before a pullback or correction hits. So that's how it uses the macro picture to change or tweak its behavior. So now let's talk about the actual trades themselves. So how does it actually go about taking trades on an individual stock? Let's say markets are bullish, VIX is low, money's flowing into the growth and risky sectors of the market. So it knows that it's a bullish market. Now it needs to look for trades. So what it does is it uses a bunch of indicators, and I may make a video of this later, going into each indicator, but I want to keep this video short. So I'll give you an overview of what indicators does it use. So it uses these indicators that I have listed here. So it uses EMAs, exponential moving average, to define long-term direction. And then it uses two different MACDs, fast MACD to detect early entry signals, and a slow MACD to determine the long-term trend for a stock. By just determining the trend of a stock and taking trades in that direction is not enough, because what happens is markets keep going up, and at some point the music does stop. So and then a pullback happens. So how can you determine what point you need to slow down and stop taking trades before that eventual correction hits? So there are indicators for that too. For example, it uses a relative strength index, or RSI indicator. So if RSI goes into overbought zone, it will not take a trade. CCI also offers similar signals like overbought and oversold signals. Then it uses linear regression and rate of change. So that is also a way of detecting if momentum is slowing down and a rally is losing steam. So it uses the combination of these indicators to determine when it needs to back off and slow down. Now, just because something is overbought, it doesn't mean that a pullback is right around the corner, but it's a really good time to get start getting conservative. So that's what the algo does. So it will it will start reducing its allocation as it detects overbought conditions. Then one of the things I mentioned in my original book, Mean Reversion Trading, is that earnings are a binary event, and a binary event is basically a coin flip outcome. So let's say Apple has earnings tomorrow and you have a bullish trade. Now, Apple can drop 18%, or it can go up 12% tomorrow. Nobody knows. So that's what makes it like a gambling like event, or a binary event. So I have this strict rule that I never take trades on any stocks that have earnings overlapping my expiration. So the algorithm also follows that rule. If any stock has earnings coming up in the next 40 days, it doesn't take any trade on that. If any stock had earnings in the previous 5 days, it also doesn't take any trades on that stock. And the reason for that is because the algorithm uses technical indicators to determine the direction of the stock. And when earnings bring knee-jerk reactions with them, huge gap downs, gap ups. So when those things happen, the technical indicators on the chart become ineffective for at least, I would say, 5 to 7 days after the earnings. So you can't rely on technical indicators to make that judgment call to determine which direction the stock is going. Because of that, it simply skips trades on stocks which had earnings in the last 5 days. And finally, macroeconomic events. We are living in a highly inflation obsessed environment. So every week we have macroeconomic data being dropped on us. So for example, CPI, Consumer Price Index, PPI, could be GDP, could be retail sales, could be core PCE, FOMC rate decision. So all these events, all these data points keep getting dropped on us almost on a weekly basis. So certain events have more weightage on how the markets may react. Certain events have less weightage. And in my back tests, I initially what I did was, because these events do bring a lot of uncertainty into the markets. In my back test, what I did was I tried skipping trades when I know that these events are lined up. So, for example, on Thursday, let's say FOMC meeting, FOMC rate decision is coming up. I made the algorithm skip trading until that event is done. And when I ran my back tests, I was surprised that the win rate of the algorithm actually dropped significantly. I was thinking that, if I skirt around the uncertain events, then my win rate should be more consistent, but it wasn't the case. So because of that, it's aware of these events. And if you are part of our Discord server, you will see that it on a daily basis, it posts a list of macroeconomic events that are coming up, but it doesn't take that into account when finding trade setups. So now let's go into some level of detail on the indicator that I mentioned. So to determine long-term trend direction, it uses EMAs. So the first indicator uses is three EMAs. One is the 8 EMA, one is the 21 EMA, and 34 EMA. Now, if you are part of our Discord server, you will see that I do use these in my trading too. And in my weekly market outlook, sometimes I will mention them. But the algorithm does use these because um, the algorithm is not just a mean reversion algorithm. It's a hybrid mean reversion plus trend following algorithm. And EMAs are a well-established way determining long-term trends for trend followers. So it does use EMAs, and then it uses two versions of MACD to find its trades. The regular MACD, which has the settings are 12, 26, 9, uh, is considered very reliable to spot longer term trends. So whenever a MACD crossover happens, a trend is changing. So it's considered reliable, but the problem is that it's a lagging indicator. And because there is a lag built into it, you will usually miss out a significant period where you could have taken trades when the trend is changing. So let's say you are in a correction and you're waiting for the correction to be over before you start taking bullish trades, and you're watching MACD. What will happen is markets will turn around, they will start going up. MACD might catch up maybe 7 days, 10 days, even 2 weeks later, and show you that the trend has turned bullish. Now, the problem with that is you have already missed a nice window of 2 weeks to take on some bullish trades and take advantage of the correction. So that's where a faster MACD can solve that problem. So I use a faster version of the MACD with a 5-13-5 setting. And what that does is it provides really good early entry signals. So if the regular MACD tells you 2 weeks later that the correction or pullback is over, the fast MACD might tell you within 3 days. So that allows the algorithm to start taking trades early on. The second thing is, and this is as important as determining trend, and it's basically figuring out when to slow down your trading or when to become more cautious. So what the algorithm does is it uses a bunch of indicators to determine when the upward momentum is slowing down. And by figuring that out, it's able to drop its exposure to the markets. So the thing is, markets can keep going up for a long time, even when they're overbought. But when markets become overbought, what the algorithm does is it doesn't know when a pullback or correction might be coming up, but it does know that the markets are overbought. So what it does is it slowly starts stepping its allocation down. It doesn't drastically cut its allocation, but every day it sees that the markets are overbought, it will start reducing its allocation percentage by percentage. So what that does is it becomes conservative, and when that eventually the correction or pullback hits, uh, it's less exposed to the market, so the damage, any kind of damage that correction may bring, is reduced by doing that. So to determine a loss of upward momentum or overbought markets, it uses indicators like RSI and CCI, which can tell you, which can detect overbought conditions. It uses a linear regression and rate of change to determine if the momentum is weakening. And then it also uses DMI, which is an indicator I use all the time in my group, to determine the dominant trend. Now, as I mentioned, avoiding binary events is a key part of my trading. And there are two kinds of binary events. One is earnings, individual stocks, earnings reports, and then macroeconomic binary events. So, for example, a rate cut decision, a Fed's rate cut decision might be scheduled on Wednesday of a certain week. That can bring significant volatility to the markets. And nobody knows what the decision is, and hence it's a binary event. Similarly, CPI, Consumer Price Index, you don't know what the data is going to be until they release it. So that's also a binary event. The way the algorithm is written right now, it is aware of macroeconomic binary events, but it will not avoid trading around them. And as I mentioned earlier, the reason for that is I did run two sets of back tests, one with where the algo was skipping trades around the binary macroeconomic binary events, and another version where it would just ignore that there's a binary event about to happen. So in all my tests spanning 10 years, it always did better in those cases where it did not skip trading. And again, this was a surprise for me because um, common sense would tell you that skipping trades around these binary events should give you more consistent profits, but that wasn't the case. It doesn't use macroeconomic binary events to change the way it trades. It does skip trading when earnings are scheduled. So I mentioned earlier, if there are earnings coming up for any stock in the next 40 days, it will not take any trades. If a stock has reported earnings in the last 5 days, it also skips trading. So those are the high level indicators and rules built into Maya to look for trade setups. Now, I do want to mention that Maya is live and taking trades in my live accounts and posting them on Discord server. And until June 22nd, all our Discord members have free access to the algorithm. And after that, it will be offered for as an optional add-on for $50 a month. We do have an early bird offer of $30 per month for the first 100 seats, and that is getting filled up pretty quick. So if you are interested in experiencing the trading algorithm, come join us, take a 14-day trial. It's a no obligation trial for $20 and just experience how Maya trades. If you like it, stay with us. If not, you can cancel your account. I also want to mention what might be coming up next. So a common question that I get from a lot of our members is, can Maya trade my account for me? So I know copy trading or auto trading is the ultimate goal, but there are legal implications around that. So that is something that I'm currently researching. I have researched several copy trading platforms like Ava Trade, Zulu Trade, eToro. There are plenty of them, but I would say 99% of them are tuned for stocks only. So none of them support options. Even if they support options, they don't support vertical spreads. So that is that research is ongoing on my part. I might just end up developing my own platform for that if I can't find any, but it's a work in progress. The second thing is There is so much complexity in the way Maya works that it's hard for me to give you the indicators and the settings and all the details in 1 or 2 videos. Later this year, I'll start working on my new book called Trend Following Using Option Spreads. And in that book, I'll go into detail explaining exactly what process I followed to develop my algorithm, what challenges I faced, and all the details of how one can develop a fully automated rules-based trading system. So that's all I have for now, and I will be making another video soon to explain the the trade management piece of the algorithm because uh, taking trades, opening trades, finding trade setups is the easier part. The place where Maya really shines is its trade management piece. So without trade management, opening a bunch of trades is meaningless because eventually what will happen is some trades will become losers, and the only way to have positive expectancy in your portfolio is for your winners to add up more than your losers. So the trade management piece is critical, and I'll soon be releasing another video to explain how the trade management piece works.